Okay, well, we'll go ahead and get this thing started. This is F3 Family, Friends, and Finance, our monthly financial education webinar. We talk about questions, concerns, issues, risks, opportunities, financial strategies, try to educate you on these and answer questions on a different financial topic each month. The third Friday of each month, Family, Friends, and Finance. That's why we call it F3. I am Peter Richon with Richon Planning, your host for these F3 series of financial education topical webinars and conversations. And this month's webinar is centered around maybe one of the most debated financial products or vehicles. And there are all kinds of financial products and vehicles. There are stocks, bonds, mutual funds, CDs, ETFs, notes, but maybe one of the most debated are annuities. And people have pretty strong opinions on annuities on one side or the other. So on this month's edition, we're going to be talking about understanding annuities and trying to figure out if they are right for your retirement. So glad you are along with us for the ride. And if you have wondered about annuities, if you own an annuity, if you've got questions about annuities, stick around. This webinar is absolutely for you. If you've got questions about retirement topics, we hold a new webinar on different issues, different topics of conversation every month. So I encourage you, if this is your first time, do stay tuned. And you are always welcome to join our list. I'd love for you to like, to comment, to send us other topics that you might be interested in hearing discussed, because we would love to discuss the things that people have questions about here on the webinar. So once again, Peter Richon, and let's go ahead and dive in. I'm going to go ahead and share my screen here. Technology's always fun. Bear with me for just one moment while I figure this one out. All right, I think we've got it pretty quickly. So at Richon Planning, we put together what we call the optimized retirement plan so that your someday, the someday that you hope for, can start today. And in order for that someday to actually happen, you do need to start planning for it today, because the only way that we can live the someday that we envision is if we also have planned and prepared for the someday that we worry about. So someday I want to buy a vacation home or travel the world or retire. But what if someday the market crashes? What if someday taxes change? What if someday there is inflation? That's why you need a plan, an optimized plan along the way. And we believe at Richon Planning that that optimized plan consists of a number of parts that are often overlooked or ignored. Today on this webinar, we're going to be talking about understanding annuities and are they right for your retirement. Now, an annuity may or may not be a right fit, may or may not be appropriate for your situation. As with any financial discussion, always take it with a grain of salt. The information is generic in nature. Anything I talk about on today's program is not intended as a specific recommendation. Certainly, annuities are more complex. This is not tax, this is not financial, this is not legal advice for you, and you should consult your own professional before taking any action of any financial, tax, or legal nature, and making sure that the information that you've heard is correct, appropriate, suitable, and the thing that is best for you. So now that all that is out of the way, our optimized retirement plan does consist of 5 critical pillars: income, investments, taxes, healthcare, and legacy. We believe that all 5 of these should be addressed for a realistic chance of lasting financial confidence. Most people have done a good job in a couple of these areas, but leave a couple of them overlooked. And most people during their working career have an income. They have an income plan. The plan is set the alarm, show up to work, and earn money. That's the income plan. When you have an income, what you need is an investment plan and an investment portfolio. And a lot of the people that we've talked to have done a good job in getting some of their income moved over into investments, into those vehicles: stocks, bonds, mutual funds, ETFs, 401ks, IRAs, Roths, what have you. any number of different options in the market to invest. However, a lot of people have not reversed course. They have not stopped the primary income plan of showing up to work, retired, and then lived off the investments. When you have an income, you need an investment plan. When you have investments, you need an income plan. And a lot of people have not structured that income plan. And of course, again, the 5 pillars of a complete plan include taxes, healthcare, and legacy. A lot of the people that we talk to recognize and understand that there are problems and issues on the horizon with paying taxes, don't want to have to pay too much, with what the cost and expense might be related to healthcare issues, and maybe even understand that they have not perfectly formulated that legacy plan yet. However, most people maybe overlook one of the biggest issues and problems and risks to their lasting financial confidence, and that is the lack of a solid income plan. And I think that that is where annuities may show their value, but also be most widely debated. Are they suitable? Are they appropriate? Are they the best vehicle to generate income from an investment account or a lump sum that you might have saved and built and accumulated over your working career? So, are annuities right for your retirement plan? And I think the problem in figuring that out is that we've had so much conflicting information. On one side, we have advisors who might only have access to annuities saying that they're the best product ever for retirement. They offer guaranteed income and lifetime security, protection from the market, maybe even some tax advantages and peace of mind. And on the other side, we have advisors just as experienced, just as qualified, that say annuities are terrible and never ever buy one. They say there are high fees, there's no liquidity, no flexibility, they're complicated. And both are right, but neither is universally right. The truth is that annuities are complex, and there are many different types. So today's roadmap, we're going to try to understand annuities, the 4 major types, and what can cause some confusion. We're going to go over some myths and facts about annuities, when annuities may be appropriate. We're going to go over some specific warnings and questions to ask if you are considering an annuity. We're going to go over benefits and trade-offs and disadvantages. Where there's a pro, there is always a con when it comes to money. Every financial product has both pros and cons, benefits and disadvantages. There is no perfect financial instrument that is right for everyone in all circumstances. There is also no financial instrument that is always the wrong answer. And so we'll go over the benefits and the disadvantages and try to understand where an annuity might be appropriate and what an annuity is absolutely not an appropriate consideration for. We'll also go over some real-world case studies and help you with maybe a decision framework to help you decide if an annuity is right for you. So, what are some of the retirement challenges? You know, I think the biggest one that people think of is the market, the stock market. It's wild, it's unpredictable, undependable. It has gone up over time, but we worry about that time where it doesn't. However, that might not be the true challenge of retirement. I think the biggest challenge of retirement is the length of retirement, our longevity, something that we hope for. A long lifespan is actually a financial challenge. Not only a financial challenge in and of itself, but it multiplies all of the other risks that we might face. If we have a very short lifespan in retirement, then market volatility probably won't impact us too much. Tax rates going up in the future, inflation, those things might not affect us too much. But over a 30 or possibly 35 or 40-year lifespan in retirement, those things are more likely to impact us. Not once, not twice, but over and over again, for years, for decades. So our longer life expectancy is actually the top retirement challenge. Compound that with longer lives means longer retirements. We are retired for longer because we're still wanting to retire at about the same age, right? That 60 to 65, maybe we push it to 70 kind of window is when people are retiring still, but our life expectancies have gone. Not only is retirement longer, but it costs more. Costs are higher, and we are more active in retirement today. Activity costs money. We spend more money. There are fewer pensions, there's market volatility, taxes, inflation, healthcare costs, and more. Those are the concerns of today's retiree. And again, when we have an income that's maybe not, those factors are not as much of a challenge or a concern. But when we reverse the flow and we are living on a finite amount of money, whatever we've been able to save, and we have an unknown amount of time and an unknown amount of expenses in front of us, that's where the real question and concerns start to arise. The direction of your money matters as much, if not more, than the direction of the market. And I'm going to explain this, but as we retire, we are no longer contributors. We're no longer accumulating. We're no longer adding to those investment accounts the same way that we were when we were working. And the paycheck provided us with the ability to cover our baseline expenses. When we are retired, now the lump sum is there to try to replace our work and our paycheck. But the direction of our money has changed. How does that impact the way that the market works for our benefit or detriment? Well, in our working years, we are saving, we are investing, we are turning income into investments by making those contributions. We need investment management. But during retirement, we are turning assets into hopefully reliable income. And that's where we need income planning. We turn from accumulation to preservation to income distributions. So, what is an annuity and why, during this particular transition, are we hearing so much about annuities? Annuities are, in their simplest form, a contract with an insurance company that is designed to address certainty and provide certain protections, whether it be principal protection or tax-deferred growth or income guarantees. They are an instrument that provides a guaranteed stream of income, much like pensions used to offer employees and retirees from companies, much like what Social Security is relied upon for. It's a stream of income that we can count and rely on and not outlive. In fact, Social Security and pensions are forms of annuity. One is a government-sponsored and mandated annuity, and the other is a corporate-sponsored annuity for being an employee of a company. However, we worry about the solvency of Social Security. We've seen pensions go away because companies chose to exit that and offer us the ability instead to accumulate our own lump sum in 401ks and retirement accounts. And so now this generation, which has done better in saving and investing and amassing and accumulating more personal wealth and investment and net worth than any other previous generation, has their life savings and the question of, how do I know it's going to last? How do I know that I'm not going to run out of money? And annuities, again, offer specific protections that will address those questions and concerns. But there are different types of annuities, and not all types of annuities do the same job. So, breaking it down, there are 4 major types of annuities, and some of them go by different names. So, fixed indexed, variable, and immediate annuities are the 4 major types. There's also maybe deferred annuities that you might hear about. That could be fixed indexed, that could be variable, that could be fixed. Deferred means you're not taking income right away, so not an immediate annuity. We might hear about MYGAs, multi-year guaranteed annuities. Those are generally the fixed annuities, the fixed category. We also might hear about hybrid annuities. They have the best of both worlds. They do a couple different things, the jobs of both fixed and variable or fixed and immediate. Hybrid is generally going to be the fixed indexed annuity. But a fixed annuity, going back to these four types, is a set interest rate for a specific period of time. The time commitment is fixed and the interest rate is fixed. At the end of the time commitment, you can walk away with your lump sum and the interest that you have earned and go a different direction, do a different thing completely. That time period is maybe 3 or 5 or 7 years. You get to determine that as you are considering what product to go into, but generally they pay a little bit more than a bank type product of an equal time commitment. Like if we are looking at CDs that as a 3-year CD versus a 3-year fixed annuity, the interest rate in the fixed annuity is going to be higher, but they also come with penalties, as most all annuities do, if you walk away during the commitment period. They also offer tax deferral on the growth. So as you are growing and earning and accumulating interest in annuities, you would not get a 1099 INT each year, taking back some of the interest that you've earned like you would with a similar bank style product, like a 3-year CD. You get taxed on that interest every year, but you will be taxed at the end of the road. It's not like we're foregoing taxes completely. We are simply delaying and deferring them. So fixed is a set interest rate for a specific period of time. A fixed indexed annuity can share in market-linked gains. Now, they do not have risk of market losses because you're not invested directly in the market. And this is one of the sources of confusion and frustration, I feel, is that fixed indexed annuities have sort of been made out to be the best thing since sliced bread. You don't have any of the risk of the market and you can make all of the gains of the market. Ladies and gentlemen, where there is no risk of loss, you are not going to get all of the benefits of the upside and gains of the market. So people get into these with the expectation, sometimes because they've been led to believe this, that they will make all of the gains of the market. And we'll get into that in a little bit, the specifics of why that belief might be there. But I'm here to tell you that when there is no risk of loss, you are not going to get all of the gains of the market. You may share in those gains. And oftentimes the share that you receive is limited. It will not be highly generous. However, there are some options that do offer some pretty reasonable opportunities for growth without the risk of loss. So if you're looking for principal protection and growth, this may be an option to consider. Then there is variable annuities, and variable annuities are directly invested in the market. They are at risk. And they oftentimes do come with fees associated with them, which we will also get into a little later in the webinar here. But variable annuities, I do see as the source of a lot of confusion because people might go into their financial office and ask for safety for some of their money and then walk out with a variable annuity, which does have market risk. So just make sure that you understand the type of annuity that you are getting into. And we'll have some specific questions to come that will help you determine that and help you determine if that is the right type for the goals that you have. Immediate annuities, as the name implies, generate income immediately, generally within 30 to 60 days of the time you make a deposit, and oftentimes are a final decision that cannot be undone or revoked. And that part is another area where annuities caused some confusion and frustration. The fact that we can't reverse the decision in certain types of annuities or after a certain point in annuities, that we lose that flexibility, was the point of a lot of concern and frustration and misunderstanding. So the four major types of annuities: fixed, fixed indexed, variable, and immediate, and they all do different jobs. It's kind of like saying that a skateboard, a bicycle, a motorcycle, a sedan, a SUV, a pickup truck are all transportation. They do all fit the description of transportation, but they're all very different. And if you're expecting an SUV and you get a bicycle, you might be very disappointed in the transportation that you have received. And so if you get the wrong annuity, again, it can be the source of frustration, confusion, and some problems. So let's go over some myths and facts about annuities. Myth number one, I think we just addressed it, that all annuities are the same. Absolutely a myth. The fact is that different annuities solve different retirement problems. Myth number two, you'll lose your money or control of your money. Now, annuities come with liquidity limitations and restrictions for a period of time, and liquidity needs to be discussed, it needs to be understood. Need for liquidity should be addressed because the annuity is not going to be the source of 100% immediate liquidity if it comes down to needing to get your hands on some money. There's going to be some limits, some restrictions, some penalties and limitations, at least for a period of time. So you do need to understand that. But there are often liquidity provisions, free withdrawal amounts, walk away lump sum options after a certain point. And with today's annuities, there are often death benefits. If you die, you don't lose all of your money. Myth that you give up control forever. This is also not true generally in most of today's annuities. You do have limited liquidity and might not be able to take all of your money all at once immediately, but there are points in the future where you do have control, and you have also taken control of certain risks, specific risks, like I don't want to lose money. Well, I don't really have control of that in the market. So am I gaining control or losing control if I was to consider moving market money into an annuity if I don't want to lose money? If my concern is I would like a guaranteed stream of income that I know I can't outlive, well, am I gaining control of that or losing control if I were to position some dollars in an annuity to provide for a guaranteed lifetime stream of income? But where you're gaining something, you're always giving up something else, and you do need to understand that. Liquidity provisions are there for penalty-free withdrawals. There are guarantees of interest. There can be guarantees of market protection and certainly guarantees for income. So it's a give and take. We are giving up some control of certain elements, and we are taking control of other elements. Another myth, annuities are expensive and have high fees. Now, this is a sometimes thing. Sometimes that's true. It's not always a myth. The fact is that some annuities have no annual fees at all whatsoever. On a fixed annuity, generally the interest rate is the interest rate. That's what you get. There's no fees attached to it, and you get to walk away at the end of that fixed period of time. Some do have modest fees. You might add a fee for liquidity or to be able to take out the interest along the way, or to add on an additional provision of protection like a lifetime income benefit rider or a death benefit rider perhaps. Some of those are optional. You might choose to pay a fee, but you need to understand this, not only the cost, but what you are getting for it, and vice versa. If I want this quality, how much does that cost in terms of fees? And then some do have higher fees. Variable annuities in particular were for a very long time notorious for their higher fees. Now, I have seen some with some pretty low and reasonable fees. However, oftentimes there are stacked fees inside of variable annuities. There might be an admin fee. There's what's called an M&E, mortality expense ratio. There's sub-account fees, and then there's rider fees. And so these can stack up. You do need to understand the cost of not only annuities, but any financial instrument that you are getting into. I see this with mutual funds also. There are some mutual funds with very reasonable internal expense ratios. They might be 0.2 or 0.25%. And then some mutual funds cost 2% before you even make any money. That's the expense of the mutual fund. So that That quality is not really exclusive to annuities. You just need to understand the cost of your money wherever you put it. Another myth, annuities are only recommended for commissions. Now, annuities do pay commissions, and this can be the source of some potential conflict of interest between an advisor and a client or an investor. Commissions can create that potential for conflicts to exist. And that's why we do need to be very careful. When we are considering an annuity, we need to understand the motivations, our motivations and the advisor's motivations. And we want to deal with somebody who does have some incentive to be there with us side by side, to hold our hand not only when the sale is made and the commission is earned. We don't want them to sell that and then ride off into the sunset and we never hear from them again. We want somebody to provide us continued service on the product so that we can better understand it and utilize it. Not just turn up again in another 4 years when they want to sell us another annuity or replace the annuity that we purchased from them the first time. Now, there are reasons why we might want to purchase additional annuities or replace annuities from time to time, but we do need to consider the potential for there to be a conflict created by an upfront commission. There is potential for conflict in compensation in the financial world almost anywhere. And it is important that when dealing with investments, you are dealing with a fiduciary advisor. But I do want to clarify that in the eyes of the financial world, an upfront commission and the fiduciary standard by nature can have some conflict. So you need to understand the producer's motivations, the commission that they will earn, the advisor's reason for recommending it, as well as, and most importantly, your reason for considering it. What job do you want done? You need to know if the product is suitable, what are your intended purposes. You do need to understand the advisor's model for service after the sale and the planning process. How did we arrive at the conclusion that an annuity was appropriate in the first place? And then how did we choose the specific product that is being recommended? I've got a long way to go and I don't want to take up too much of your time today, so I'm going to move through some of these. But consider your goals very carefully. Prevent potential conflicts, but understand when an annuity makes sense because of what it can help you accomplish. What tools can help you address these risks? There are many. An annuity might not be the only tool. But when does an annuity make sense? Well, when you have a lump sum, but you need an income, or you want safety and protection for some of your money. You worry about running out of money, you worry about the market volatility, or you want leverage in producing as much income as possible from a finite dollar amount. An annuity might make sense when you don't want to rely on an unpredictable or undependable stock market to produce a needed amount of income reliably. And so let's compare the market to an annuity. And let's compare the direction of our money. As I stated earlier, the direction of your money matters as much, if not more, than the direction of the market. And to illustrate this, this is something that I've gone over in previous webinars, so I don't plan on spending too much time or as much time, but you can review my explanation of this in previous webinars. But I chose to use the real world returns of the S&P 500 over a 20-year period. So we are using the real world returns of the S&P over the 20 years from 2000 through 2019. And yes, this was a particularly challenging time in the market. That's why I chose this period of time specifically, because I am not very confident about my ability to predict that the next 20 years is going to be as good as the last 20 years, or what the next 20 years has in store. And I would rather plan and prepare for those times to be a little bit more challenging and then be pleasantly surprised than project out that everything is rose-colored glasses and rainbows and then be unpleasantly surprised that it's a more challenging period. But here's our scenario. Using those real world returns of the S&P 500, what if we started with zero and added $25,000 per year for 20 years? That's $500,000 that we've contributed as the market has been moving up and down and sideways for a period of time. Up, down, sideways for 20 years. We add 500,000, and at the end of that 20 years, we have $1.162 million. That is something that I think most people would be pretty happy with. We were dollar cost averaging, we were working, we had a paycheck, we were making contributions, and we took advantage of the market. You would think that if somebody started this same period with $500,000 already, that clearly they would end up with more over the same period, same market returns. However, you would be surprised to be wrong. If somebody had $500,000 to start this same period of time, did not add, did not take away from the account, just held the account with the same market returns, at the end of that period of time, they would have $1.099 million. They were flat for a period of time. In fact, they took a bit of a roller coaster ride. Lost 50% twice, gained 100% twice, and then made gains. That's while the person who was contributing was dollar cost averaging in the background here. They were growing their money while the person who already had 500,000 was losing and gaining back and losing and gaining back. So you can already see the difference between making contributions versus just holding your money. That's a difference in direction of your money. The direction of the market is the same between these two scenarios. Now, what if we add a third direction of money? What if we start making withdrawals like you do in retirement? We start with 500,000. We start taking out the same $25,000 per year that when we were working we had been adding. We take that out for income with the same market returns, and 17 years into retirement, we are out of money. In fact, only about 10 years into retirement, we have about half of what we started with. And I don't know when in my retirement I'm going to be comfortable saying, well, I still have half, I should be okay. But it's certainly not going to be 10 years into retirement. And nobody wants to reach this point here and run out of money. That is the biggest fear of retirement. So you can see, using the same market, same exact market returns, the impact of the direction your money is moving is very impactful, very important. There again are the three directions side by side. Retirement, however, is where less risk might mean more confidence, more dependability, and maybe even more income. What do I mean by that? Well, if we, instead of the S&P returns that we know have already run us out of money after 17 years, what if we replace that with a lower, more stable, predictable, just 4% rate of return? And by the way, the average rate of return over this 20 years was just about 6%. It's not the 10% that everybody talks about the market always does. The market doesn't always do anything. It's unpredictable, and the average growth over the history of the market might be near 10%, but for this 20-year period, it was closer to about 6%. But still, that's 50% higher rate of return than what I'm talking about here with our 4% rate. And yet there weren't losses. There were no negative years. We always had a stable, low, but positive 4% rate of return. So what does that do when we start creating income? Well, we're taking out the same $25,000 a year, but we don't run out after 17 years. Even with a lower rate of return, I actually have to add 20 additional years to the chart before that lower rate of return would run out. Now, still runs out eventually. And that's what people don't want to do in retirement. Where does an annuity play in? Well, an annuity is kind of that lower, stable, predictable rate of return. However, when the annuity is paying out that income, even if the balance reaches zero, you still get the continued guarantee of lifetime income that you can count and depend and rely on. And that's where an annuity can add some comfort and confidence and certainty to retirement. So the question is, where is our mind focused? Is it on the potential for the higher possible returns, or is it on higher probability? And during our working years, when we have a paycheck, I do think we need to be focused on the higher potential, the higher rate of return, the higher possibility. But once the paycheck stops and we have what we have, and we're not planning on earning more, maybe we need to shift focus to a higher probability. And the problem is that a lot of people don't. So when we look at our retirement nest egg and how many years we might live in retirement and how much income we want to pull, what is our probability of success? And a lot of people look up here and say, well, that $2 million that I have today, it can grow to a substantial amount and I'll die and leave 4 million or more behind. But they don't focus on this probability that, well, we might run out of money if we are using the market as the source of income. There's a chance. And if the weatherman says there's a 10% chance of rain today, I might leave the house without my umbrella. But if my retirement is based on a model that leaves me about a 10% chance of running out in retirement, I'm worried about that probability. So when does an annuity make sense? Well, there's a number of places. And again, when we need a dependable, reliable, durable stream of income, we've got a lump sum and we need an income. That's one place, but there are a couple others. I do believe that an annuity can make sense when we are looking at the widow's penalty and income reduction for a surviving spouse. You know, if two people are alive during their joint lifetimes, married filing jointly, our tax rates are in higher brackets, meaning we pay lower rates. And our Medicare premiums are not impacted by IRMA until we get to a much higher income. But when one spouse passes away, suddenly those income brackets and those IRMA brackets fall substantially for the surviving spouse. Well, maybe we want to give that surviving spouse some income replacement for when that time comes, because in addition to the brackets being less favorable and penalizing a widow or a surviving spouse, the income is also cut. A surviving spouse is going to lose one of the two Social Securities and maybe part of a pension that was there. So an annuity may make sense to make up for lost income. Another area where they are not often talked about is RMD management. And at this point in time, if you're in this webinar watching to this point, you probably understand what RMDs are, but they are the IRS's mandated method of collecting the tax that you've deferred, a required minimum distribution. And most people have not looked at what their balance is going to equate to as far as the amount of required distribution into the future. We have calculators that can do this and show you, hey, at a 2% rate, a 4% rate, a 5% rate of return, here's what your RMD is going to be in the future, all the way up if you want to do 10 or 12%. We can project those out. But most people have never looked at this. They are aware that the RMDs exist, but don't know how much they will be and don't know how that will impact their taxes. And these are where all of the pillars of the optimized retirement plan kind of interconnect. Well, for RMD management, if we had a $1.5 million account and a 5% rate of return, and we were 70 years old, in just a few years, we'd have to start taking those RMDs. And that RMD amount, we can sort of project and predict. On $1.5 million, we would need to take about this much with a 5% assumed growth rate. And that's the whole $1.5 million. Well, what if instead, where is less more in retirement? Where does 1/2 equal 1 whole? What if instead we took half that amount and put it in an annuity to pay out income? We deferred it for the same amount of time and then started taking a guaranteed lifetime income. Well, now just half of the IRA balance more than accounts for all of the $1.5 million RMD amount. And it does that for several years. The annuity carries more than its fair share of the weight of the RMD amount. But wait, what did we do with the other half of the money? We left it invested for a longer period of time. We can see that if we take these RMDs that will deplete our balance. We assume about a 5% rate of return here. However, if we use the same return, a 5% rate of return assumed on just $750,000 without having to take distributions, that amount grows to 1.9 million, whereas over here we only had 1.3 million left at the end of this period of time. The annuity keeps paying out the income that it's paying out. The growth money gets to remain growth purposed and oriented. And oh, by the way, the annuity might have some additional health care benefits if we have a long-term care kind of scenario. The amount of income might double to help us offset the cost of health care with no medical underwriting, by the way. And we'll get to that in just a moment. Now, some warnings and some questions to ask. And again, I'm going to have to move through these pretty quickly, but don't be lured into an annuity by an upfront bonus, by a carrot on the string, by a lure on the end of a fishing hook. The upfront bonus is only part of the picture. And it may sound attractive that you can get this upfront bonus, but sometimes that bonus is not the end-all be-all of something that is intended for a long-term commitment. What happens day one is not the most important thing. The bonus might not determine the outcome of the annuity. So some questions to ask. What does this bonus mean for the value that I can walk away with into the future? What does this bonus mean for the income I can count and rely on? Does this bonus mean that I will earn less in the years to come if the market goes up for my share in the gains of the market? Warning, questions to ask. Understand the index that your gains will be based on. And there are all types of indexes inside of these annuities that these companies are using to kind of be the measuring stick for what your gains will be based on. Not all of them are easy to find or track. Not all of them are easy to know what you're stacking up and measuring against. So earlier when I said that some of these make it out, like you'll get all of the gains of the market, which market are we talking about? Not all index options are the same market. Some of them are basically fixed interest or bond-based market index options. So the questions to ask, what index are my gains linked to? And I like the indexes personally that are tied to the S&P 500 or the NASDAQ or some easy to find and easy to track index, not some obscure index that is very hard to find. So a question to ask, where can I track the index that I will be linked to? What has the performance of this index been over the last 10 years? How frequently will my gains lock in? There are some index options that don't lock in for 2 or 3 or 5 years. And so if you have one good year and then the next year is down, well, you didn't benefit at all from the first good year. Whereas others lock in every year. And so if it goes up and down, at least we got some gains from that first year. And can the amount of gain that I receive be changed during the commitment period of the contract? All important questions to ask. Don't base your expectations on hypothetical illustrations. Oftentimes, these are a little bit more generous than what we should expect in reality. Illustrated rates on market-linked gains are not guaranteed. Ask, what gains will I make if the market's down? Are these guaranteed or hypothetical projections? How do market gains affect my guaranteed income? Understand the type, the purpose of the specific product. Not all products are intended for the same purpose. Does this product provide guaranteed lifetime income? Is this intended for me to walk away with a lump sum? And if so, when? Does guaranteeing lifetime income require annuitization? And this is where your decision becomes final and you no longer have the ability to walk away with your lump sum of money. Will I be paying for any riders that I don't need, like a bonus or a death benefit rider? Yes, some of the bonuses that you receive actually get taken back with the fee that they charge to get the bonus over the commitment period of the annuity. And these are kind of the inner workings that lead to some frustration, confusion with annuities. and where I can see that that is very reasonable. So these are some of the questions to ask. Again, understand the liquidity, the time commitment. Annuities are long term. How long before I can get my last dollar out without penalty? What is my annual amount of liquidity? Free withdrawal with no penalty. If I do want a lifetime income, how long do I have to wait before starting that, before turning that on? Some can be started immediately. Some you have to wait a year and a day. Some annuities, you have to wait 10 years before you are even eligible to start a lifetime income. Make sure you understand that. Some of those come with bonuses up front too that make it seem great at first, but then you've got to wait 10 years with lower than desired share in the gains of the market. So what is the liquidity if I do change plans or maybe have a healthcare event or emergency? Don't forget to ask about fees. Don't forget the fees or the fee. Not all annuities have fees, but many do, and you do need to understand those costs. So are there any flat or administrative or account fees? Are there any sub-account fees or index options? Yes, some of the fixed index annuities claim that you can share in the gains of the market and not have any losses, but if the market is down, there might be a fee for that index option. You still might see less on your bottom line. So if the market is down or flat, will I see any fee reduce my balance? Are there any riders that I've added? Do those have fees? What are they? What value does paying this fee provide me? And an annuity is absolutely not a plan. Annuities are never the right place for all of your money. And unfortunately, I think this is another point of contention with annuities, is that oftentimes they are seen as the plan. They can be part of a plan, but never the entire plan. So what portion of my assets are appropriate for this annuity? If I need access to funds, where will I pull them from without incurring a penalty? If this annuity is providing for income, what other funds are providing for other needs like liquidity and growth? Why, advisor, would you suggest this annuity over other alternatives? And there are other alternatives. Do you have any additional incentive to suggest this company or this product over others? Or is this the one that is best for me? And get it in writing. Don't just take verbal description as fact. All annuity products have company brochures and product-specific brochures. So when you ask these questions, can you put that explanation in writing for me? Can I have a copy of the company and product brochure? Because clarity and understanding are the key to a good evaluation of if the product is appropriate and a good experience with it once you have gotten into it. So make sure that you understand it, and these are some helpful questions for you. Don't forget there are other options. Annuities are absolutely not the only solution, but they do provide certain benefits and protections that other options do not. Consider your need for income dependability, your desire and your comfort level with the risk of the market, and how some of those other options might help address concerns that annuities don't help you address. Liquidity, time commitment, flexibility, those things are items that an annuity will not help you address. You need those things with other pots of money. So, decision time, framework. What problem are you trying to solve? Income, protection, growth, legacy, liquidity. Those are the things that are going to help you determine if an annuity is appropriate, and if so, which one, or maybe if an annuity is not appropriate for your situation. Annuities are not one size fits all. They are tools, so evaluate them within the context of your retirement plan. Here are some scenarios. Maybe you want a guaranteed lifetime income. You put some of your money into an annuity for a guarantee of income now and forever, and then you've got other buckets of money, someday money, maybe even never money, that's going to be purposed for your legacy and inheritance. With that kind of scenario, we can show you with a deposit of how much and a deferral period of how long, exactly how much income will this dollar investment guarantee you for life. So in this example, Mr. Avid Investor, 70 years old, has $750,000 and he is considering putting into an annuity. He's going to wait until those RMDs kick in, wait till he's 73, 4 years to start that income. And by that time, he is getting more than a 10% cash flow from his initial investment amount and is guaranteed that income for life, for as long as he will live, will walk the earth. That can provide some certainty and some confidence for income, but he's going to be sacrificing other areas. Liquidity, the opportunity for growth, and essentially by dedicating this to a lifetime income, we intend that to be a lifelong commitment, that we're not changing course with this pot of money. However, maybe we do want more flexibility in that. Well, we could consider a protect the principal and live off the interest approach. It probably will take a bigger bucket of money up front to have the now and forever income if we wanted to do that. The spigot is pouring out the income here, but you also would absolutely need some someday money down the road. What might that look like? Well, we can get a 5-year guarantee, probably in the mid 5%. So that same $750,000, we got our income for 5 years, and after 5 years, we walk away with the original amount that we deposited and go make some other choices or decisions. That can be an attractive option. If we had $500,000 in the market and we wanted to take a $20,000 a year income when we were 63, we wanted to start that at 66. That $500,000 in the market with real market returns would fluctuate, and at certain points in time would be less than half of what we started with. And yet we're trying to pull out the same amount of income each year. I don't know if I'm going to be comfortable pulling out $20,000 from $250,000 or somewhere like that as I was confident pulling it out at $500,000. Well, what if instead we put $250,000 in an annuity? For that same age, for that same time of deferral, we know that $20,120 in this example could be generated lifetime income from the annuity with $250,000 without having to worry about the fluctuations of the market. Well, what do we do with the other $250,000? If we did not have to pull income from the other $250,000 and were able to leave it alone in the market, that would grow over the same period of time to over $1 million, because we have purposed growth money for growth and income money for income. The $250,000 that we put in the annuity still gave us the same guaranteed income for life, but we let the lump sum continue to grow in the market. Annuities can also be a good backup for long-term care healthcare expenses, which are expensive. The average median cost can be projected. We can see what that is likely to be in the future, but we have no certainty over that. And none of us have any certainty of whether or not we're going to encounter those kind of expenses, but the stats on that are pretty scary. Department of Health and Human Services, most recent stats from 2023, I believe is when these stats were, that somewhere around 69 to 70% of people need some form of long-term care during their life. And if you've already had any kind of medical issue, long-term care insurance can be difficult, if not impossible, to qualify for. But if we put a deposit into an annuity, it can be in our back pocket for the potential for future healthcare costs. Not only do we have an income that we can count and rely on and know that when we turn it on, we will never outlive, but many annuities these days also offer this additional, without any medical underwriting eligibility requirements, this additional protection that they will increase the amount of income if you ever encounter a long-term care qualifying type of situation. Now, every product has different nuts and bolts on this if they offer it, so be very aware of what the stipulations and limitations are. This is by no means comprehensive long-term care coverage. It is just an additional piece of leverage potentially in your back pocket for that purpose. Now, a lot of people say, well, if I buy an annuity, I'm going to lose out on some value of my portfolio. But oftentimes, what we find is that eventually, because of the certainty of guaranteed income and the ability to have growth money doing its job exclusively rather than trying to create income and grow, that oftentimes we add value over the projection of a lifetime by including an annuity. They can be thought of as kind of the fixed income alternative. And in most portfolios, if we pull out the existing fixed income, the safety portion, and we add back in a fixed or a fixed indexed annuity, we lower the overall cost, we lower the overall risk, and we can increase the yield or the amount of income that the portfolio will produce. So are annuities good or bad? Yes, and sometimes even ugly, as Clint would attest to here. But if you have questions, if you'd like to find out more, we do have a quote engine online. If you go to Top Annuity Income, you can see what some of the income rates might be for you. And of course, if you'd like to look specifically at an annuity, which one might be appropriate, talk through questions, concerns, get a better understanding or just some education, or even understand the annuity that you may already own, we're happy to look that through with you at Richon Planning. So just give us a call, schedule a retirement income review if you've got questions. You can find us online at RichonPlanning.com. Richon Planning is the home of the optimized retirement plan. And you can call us at 919-300-5886 or scan the QR code on your screen right now, which will take you to our scheduling page. You can schedule an appointment right there or a phone call, or again, you can go to RichonPlanning.com. So glad you stuck around. I know I ran a little long today. I do apologize for that, but I hope this provided some useful, beneficial education and information on annuities for you. And again, I am so glad that you stuck around. I am Peter Richon with Richon Planning. We hold these webinars the third Friday of every month. Hope that I see you again at the next one. Take care, everybody.